Welcome to everybody who's giving up their time. I appreciate how precious everybody's time is. My name's Anne Riches from Saturn Healthcare Limited, and I'm your chair for this morning's meeting. So what I would like to do then is I would like to introduce Rebecca Brown, who's the Market Development Manager from Norfolk County Council. Comes with a wealth of experience, and what Rebecca is going to do is she's going to talk to us today in relation to the adult social care fee review, which is obviously quite a hot topic. Should bring out hopefully some really good discussion and debate, because what I'd like everybody to think about before Rebecca starts is think about examples or themes where you as a provider may be encountering challenges. So keep that in your mind, but please obviously do listen to what Rebecca is imparting to us. And then what we can do is we can start to unravel some of those things and start to unpack what might be common themes. Okay, so Rebecca, very warm welcome, and over to you.
Lovely, thank you very much. Can I just check to see if my colleagues are in the room with me? It's difficult, isn't it, when you've got your the presentation up, you can only see a few faces. So let me just check. So I should have Claire Dixon with me. Claire, are you in here?
Yes, hello. I'll introduce myself. I'm Claire Dixon. I'm the Commissioning Manager for Residential and Nursing Homes, and I'm going to be a bit co-presenting with Becky in a moment.
Brilliant, that's good news. I'm not alone. And also we should have Stephen Fell.
Yeah, I'm here as well, Becky.
Yeah, do you want to introduce yourself while we're at it?
I'm Stephen Fell. I'm one of the accountants at Norfolk County Council supporting adult social care, mainly within their commissioning field of support.
Brilliant, thank you. So I've already had an introduction, thank you very much. But yeah, my name is Becky Brown. I'm the Market Development Manager in the Commissioning and Care Markets team in Adult Social Services at Norfolk County Council. And we're here today really just to start the discussion around the annual fee review process. We've got a little bit of information that we can share with you around what we know around the current financial operating environment from our own perspective. And Stephen's going to share a couple of slides around that in a moment. We can also take questions throughout this presentation, so do feel free to either raise your hand, and if we haven't seen a hand, I'm sure somebody will let us know that there's a hand up and we can just take questions as we go. We'll also have opportunities at the end for further discussion, further questions, and we'll do what we can to answer any of those. So that's the plan for today. Claire and I will also be taking you through some of our survey findings of the most recent provider survey that we sent out in October, and we're going to have an opportunity really just to talk to you guys about whether or not the findings that we share with you represent what you're feeling at the moment within the sector, whether or not you feel they represent what's happening in your part of the market, and then for you to be able to just share additional insights with us about that. And all of this information that we gather through these opportunities, we're coming to each one of these NorCA subgroups throughout November. We'll be feeding into conversations that we're having with decision makers around the fee review process, and we'll be putting together a paper that goes to our cabinet that goes in January next year, where the decision will be made about what the fee uplift will be from April 2026, which feels like a long way away, but of course it's not that far away and we'll be here before you know it. So we normally start our engagement work around this time because we need this sort of length of lead in to be able to build in all of the insight. But yes, feel free to ask questions as we go. I'm going to share some slides now. Let's see whether or not this works okay. Let me know when you can see them. It's a nice bright green.
Can't see anything quite yet.
Should be on its way.
Yeah.
Is it there?
There it is. Yes, yeah. By the magic of the computer, there it is.
Let's kick off. So Stephen's going to take us through a couple of the financial context slides, and like I said, if you have any questions, please feel free to ask. So over to you, Stephen.
Hi, so I'm stepping in for Leon Ringer, who's the finance business partner at Norfolk County Council, to kind of go through the financial context of our annual review process. If we can move to the next slide, please, Becky. Thank you. So to give a little bit of context, in a financial position, adult social care has delivered over £100 million worth of savings over the last 8 years, and there are demands on adult social care to deliver over 40% of the annual council savings. In the current year of 25-26, we also injected 59 million into the adult social care budget to help with pressures and the market position. But we're still having pressures to manage in the current financial year. The other sort of things we've taken into account when we're looking into this are the economic factors. So we know inflation has stabilised, but it is higher than we expected at the kind of 3.8% at this moment in time, where government projections had that coming down quicker than it has done in the actual year. We've also got the aging population, so people are living longer, have multiple long-term conditions, and that's increasing the complexity of need and what's requirement at each service package. There's also the choice and expectations of people to take into account, so that's keeping people at home longer and the personalised care which goes around that. But then with people staying at home longer, by the time they enter the residential field, their complexity of needs increases, is usually the case. We've also got to understand the workforce and how that has changed over the previous year, which is despite national and local initiatives, many providers continue to report high vacancy and turnover rates and difficulties in recruiting and retaining skilled staff. So we know that is a major concern. The care quality as well. So we need to improve that in Norfolk, because our benchmarking data suggests that we are still one of the poorest in the country on that field. So that is something which we do need to look at getting an improvement on. And the significance of viability and sustainability. So we know about the financial issues which are facing the market, and trying to make sure that we are putting in appropriate items into place to kind of help support that. If we can move to the next slide, we're kind of giving you where we're up to in the budgetary terms. So this time last year, we were at a slightly better position because we already had the autumn statement. And so we already had a kind of direction from our central government colleagues about what our direction is. At this moment, the autumn statement is not till the 26th of November. So there's a lot of unknowns in our current budget setting planning for 26, 27 and onwards. Alongside that, there's also the fair funding review and a 3-year settlement. This is the first time a funding position has gone over 1 year. Last time, I believe, was the last time Labour were in power back in like 2007, 2008 sort of time. So it has been a long time since that's kind of been around. Norfolk County Council is, at this moment in time, we've got a 62.5 million funding gap as an authority to deal with, of which adult social care is going to have to plan £28 million worth of savings. The national living wage has not been announced as of yet, but the Low Pay Commission had recommended that there will be a 4.1% rise in that, which takes it to £12.71. But the range is between £12.55 and £12.86. So quite a little bit of wiggle room in there, what we have to work with. As I've kind of mentioned, CPI is currently at 3.8, but the OBR's estimation was about 2%. We are awaiting the update in November, which we usually factor into our modelling for the fee uplift process at that time. The Fair Pay Agreement is out for consultation, but won't be implemented till 2028. There's £500 million of funding being set aside for this, but we don't know how that's going to be dealt with across the markets at this moment in time, and how that will be distributed across local authorities as well. So the known drivers of costs, we know that between 60 and 70% of this is of the costs we pay are associated with labour. At which point we do take into account the national living wage. So as we can see, over since 2016 to 2026, we can kind of see what the inflationary uplifts have been across those years, with it spiking in 2023 and 2024 at nearly 10% increases in the salaries at those points. But last year we did see quite a drop, and if it goes again, we are seeing another quite significant drop in the national living increase for the national living wage. Next slide, please.
Yes, Stephen, in one of your previous slides, you mentioned that we are one of the poorest in the country. I just wanted you to, perhaps if you could elaborate on that, because that sort of made my ears prick up. So I was just thinking, why are we the poorest in the country?
So that, I believe I'll be looking at our commissioning colleagues. They're the ones that bring that information.
Sorry, I'm here. Hello. Claire as well might want to come in. I think we've got Chris Jones. So this is in terms of benchmarking for our services across the market. So we do benchmark poorly against our comparators. So in particular, our family group and our Eastern region comparators. What I would say is that quality is improving year on year in Norfolk, and we know that we have some providers that well, quite a few providers that provide really good care. And although our quality is improving slowly, we still benchmark poorly against our comparator local authorities. So there's obviously a huge amount of work that goes on by providers themselves, with our PAMS colleagues, with obviously CQC inspections, and all of the support that we put in place as a local authority to try and support providers. But as a position, I don't, now correct me if I'm wrong, Claire and Chris Jones, I don't think it was correct to say that we're the poorest in the country, but we do benchmark poorly against our comparators.
So I guess that's a good, well, I can't say good, but it's a good argument to suggest that actually we need more investment in social care in Norfolk, so that we can improve on that benchmark and become one of the best in the country rather than one of the poorest.
Absolutely. And as from Norfolk County Council's perspective, obviously our ambition is that everybody receives good and outstanding care in Norfolk. And that's all of the work that we put into place around our commissioning that's our aspiration. And obviously from providers' perspective, I'm sure that you can completely get on board with that. But there's a range of things that we know need to be in place to allow providers to be able to deliver on good quality care, and that we invest from a Norfolk County Council perspective to try and put in place support and initiatives to enable that to happen. Obviously alongside people like NorCA, who have supported the local authority and providers with things like peer-to-peer support programs, but it does still come down to the fact that although that quality is slowly improving, we still need it to keep on going in the right direction, and we do still benchmark poorly against, like we said, our comparators. Anything else to add, Claire or Chris J?
No, I think you've covered it.
Lovely.
I think you've explained that really well, Becky. Yeah.
Brilliant. Thanks very much.
Thank you.
Thanks for the question, Raj.
Thank you. Yeah, absolutely. Stephen, sorry to cut in there.
That's all right. So just moving on to what we know is the known drivers of cost, which is around the CPI inflation. So we've done a graph here, which is dating quite a long way back to 1997 to kind of show what the CPI has been tracking at. And we can see over the last 5 years now that inflation has started to skyrocket, especially around that 2022 position, where we got above 10% at that stage. It has come down significantly, and we did momentarily see it drop back down to nearly 2%, but over the course of this year has been creeping back up, and it has hit that kind of high of 3.8% at this moment in time. As I stated earlier, the OBR's previous estimates were by the 1st of April 2026, we were to be at 2% again, but we are waiting the revised modelling because that, I would say, is probably unlikely to be the position going forwards. That'll probably be, once we have the estimate of that, we will put the revised figures into our modelling perspectives to kind of come out what that should look like. So on to the next slide. We've got the financial planning. So the budget pressures for 26-27 are extremely challenging, same as every year for us. The uncertainty of the funding available and the lateness of the settlement makes this difficult for us to budget and understand the wider implications we have coming our way. It's very important for us to use the intelligence from these engagement sessions to factor into our considerations and how that will affect our modelling and the availability of the funds we have available and what we can do with each individual market. The officers of the council is important that we present the considerations to the elected members. So this is about making sure that we are abiding to the Care Act under Section 5 for promoting diversity and quality in provision of services. This will then go to our cabinet members in January 2026 for them to consider the uplift position. And it's equally important providers to have sufficient notice to understand and plan for implications on this. So I'd say that's it from me on the finance side.
Yeah, and just to sort of reiterate, I guess that when we came to these subgroups last year, we'd already had the autumn budget. So we were able to give you some stronger indications as what we were expecting our core spending power to look like. It's slightly different this year. And as Stephen mentioned, we're kind of working with ongoing kind of uncertainty. Add on top of that the 3-year settlement, which, you know, we haven't had for a long time. It just adds to the layers of kind of we won't know some of this stuff for another good few weeks. However, the bit that remains is this is still our kind of window of opportunity to talk and to speak to providers about experience and what things are feeling like. So I'll pause before we move on to the next section, which is going to look specifically at talking through some of that feedback that we've already gathered through our survey, just in case people would like to ask any questions around that, the wider kind of financial situation. Where we can, we'll obviously we'll answer those. But does anybody have any questions they'd like to raise now?
Nothing's come up in the chat or any hand raises so far, Becca. It may be a good opportunity to sort of lead seamlessly in with you giving a bit of a more generic oversight of feedback gathered so far to see what some common themes might be. But perhaps, again, building on what I said before Rebecca and Stephen started their presentation, if participants today can be thinking about those common themes, think of some specific examples. I'm sure Raj has got some building on what he was talking about earlier. Thinking about what impact these potential changes are going to have. Again, like Rebecca said, it's very difficult for us at the moment, isn't it? Because we don't really know what we're working to. There's a level of uncertainty and ambiguity around that. But obviously the NCC team are doing their best to pull something together that's probably going to hopefully cover all bases and tick the predicted boxes. But can we think about the sort of factors and the outgoing impact of those factors that might be affecting you guys at grassroots level within your own organisations, and what negative impacts that might carry, and how we can look at how we overcome those barriers, looking at how we can apportion some resources. Chris, you've just popped your hand up.
I have, if only just to add a little bit to what you were what you're saying, and around the feedback that we need from this conversation is really to get behind the kind of the numbers and the percentages, the stats that sort of appear on the slides, to understand perhaps in a bit more detail exactly what these things really mean in reality from a kind of day-to-day provider
Grassroots.
perspective, because the devil will always be in the detail around how we sort of how subjective sometimes some of these questions can be, and it's about just pulling out some of that sort of I suppose more detailed feedback from yourselves as providers around what it really means, because you can ask a question and you'll get a number that's generated off the back of it. And when we've been through this yesterday, what we established is that sometimes the way in which you answer the question can directly influence the way in which we get the result back. And I want to be really clear that actually, in order to get the sort of fee review process fully kind of publicized and engaged around, we just need to understand a bit more of that detail. So it would pay for providers to feel that they can do that here. And if you can't do that as part of this forum, then we're quite happy to talk about it separately as well. But I just thought it might be useful to put that bit of context in there, if that feels helpful.
Thank you, Chris. Incredibly, yes, absolutely. Thank you. So please, everybody, do feel free. This is a very open, safe forum to ask questions, moot ideas, and let's see if we can uncover some common themes and give some real specific examples that can aid these lovely people that have joined us today from Norfolk to put across that as part of the case. Okay, Becky, would you like to continue?
Yeah, that'd be great. Thank you.
Thank
and again,
you.
Same offer goes to everybody in the room. If you've got questions as we go, please do feel free just to ask them as we go. Brilliant. So this part is going to be primarily Claire and I, but Stephen and Chris Jones, feel free to come in if you'd like to add anything. Okay, so a couple of weeks ago, mid-October, we released the Sector Pulse survey, and this is the second year that we've run this particular survey for providers. Apologies if you have heard this presentation last year. I'm going to do a tiny bit of the context, which just sort of explains what it is and where it came from. It's based upon the Care England National Sector Pulse survey, where they've been running for several years. And last year, when I first came into this role, actually, I was saying this is an amazing data set, which really does explore and give providers an opportunity to voice how the financial operating environment is really feeling to those, but it's national. And, I didn't get a sense of, does this apply to our providers in Norfolk? Does it feel different in some way? And could we do a localised version of that? Not only would that be great for us to understand as a local authority, it gives us a bit of an additional voice that we can then compare with at a national level to say, are things similar? Do we mirror national trends? Or actually, are there specifics in Norfolk that only really relate to us, that feel a bit different? And we can bring both to conversations at Cabinet, at NCC, but wider around lobbying for fairer funding, for example. And it provided us with an opportunity to be able to do that. So last year was the first year that we did this localised version. And off the back of that, not only did we feed in providers' thoughts and obviously all of the feedback that we gathered, but it also enabled us to write 2 lobbying letters that went to central government around fairer funding for Norfolk. It focused in on the unfunded national insurance employers' contributions last year, and it just helps us to build up this evidence base to be able to utilise in different ways. So the first thing I want to say is thank you for everybody that either completed the survey last year or completed it this year, because you really are helping to build that evidence base. So 24 questions, a mixture of financial and workforce information with plenty of opportunity to provide additional detail. And the one thing that I've noticed about this survey is it really does evoke people's desire to tell us more. I'm sure everybody in the room has done surveys at different points, whether or not they're the ones asking people to do them or whether or not they're completing them. And sometimes you feel like you want to give that extra detail, sometimes you skip through. This one is a perfect example where providers really wanted to tell us about what it's feeling like, and it's added to the richness of the results. So again, thank you. So this year, we had 338 providers that have engaged with the survey. At a high level, what that means is that they've opened the survey, hopefully read the briefing that came along with it, gave a bit more of, again, that kind of contextual overview. That represented 15% increase from last year in terms of engagement. It did go on to 138 fully completed surveys. That's 5% increase from last year. And 32 of the responses overall came directly from residential and nursing providers from the older people's market primarily. And all of the results that you're going to see today are based upon those particular findings. Just a very brief overview of who completed the survey this year. So we asked just a couple of questions about who's completing the survey, what type of organisation they come from, and how many people have they been providing care and support for over the last 12 months, as well as a bit of a view as around volunteering and how much of the workforce their organisation is made up from volunteers. So this year, we've had a higher proportion of owner proprietors that have completed the survey. So just under half of all of the responses came from that group, and a smaller proportion this year of senior managers. The remaining split were between MDs, chief executives, and finance directors. From our perspective, we just are keen to make sure that whoever completes these surveys has a really good understanding of the organisation. So both from a financial perspective, because lots of the questions are based around finance, as well as the implications, staffing and workforce. So we recognise that that person or people will be different depending on the business model, individual businesses. So our main objective is the survey getting to the right people, and I think there's still more that we can do to make sure that it is. But interesting that that split shifted this year, and as I mentioned, more owners completing it. The majority of organisations that engaged with the survey from residential and nursing were on the smaller to medium size of businesses. So 38% of the organisations employed between 10 and 49 people, and 41% were employing between 50 and 249. And that's reflected in the numbers on the right-hand side of the page here, which gives you an indication of the amount of people that have been supported in those organisations over the past 12 months. We did have a small increase in the amount of organisations that completed the survey from larger organisations. So you can see in total around 6% were supporting those much larger groups of individuals over the last 12 months. And that's positive because we didn't have very many from that end of the market last year. 3/4 of organisations from residential and nursing provision reported having no volunteers as part of their workforce, but 25% suggested that between 1% and 5% of their workforce were based upon volunteers. So that's just a snapshot of the types of organisations that completed it this year. And then moving on to finance. So in modelling some of our potential scenarios around the fee uplift every year, we use a range of different information to be able to help us understand how costs are changing. We use things like these provider surveys, but we also use evidence that we've gathered through previous cost of care exercises, for example, and it's really important because they help us to understand how much of providers' total operating costs are split between the money that's spent on staffing and the amount of money that's spent on things like non-staff costs. And it's important because we use this information to model fee uplifts and what we need to do and how that changes over time. So we asked the question this year, for total operating costs, how much of your costs are staffing and non-staff? And this year, the answer was 69% of the total operating costs are based upon staffing and 31% on non-staff costs. So compared to last year, that represents a small shift towards non-staff costs actually increasing slightly more than staffing costs. We know that all cost is still increasing and that there are a couple of things that happened last year around employers' national insurance contributions that would have had an impact. But it was a very small change and it's been relatively consistent around that 69 to 70% of all costs based upon staff. This next section looked at the last 12 months. So we asked providers to look at all of their financial costs and tell us how much of the staff-related expenses or how have the staff-related expenses been feeling in terms of are they increasing, decreasing, and what that looked like. 72% of providers this year told us that their staff-related expenses have increased significantly. So we measure that by saying more than 5%, and that is an increase on last year of 6% of providers saying that that measure had increased significantly. And 28% had reported that costs had increased slightly, so between 1 and 4.9%. The bit that feels really interesting to me is this non-staff related expenses. So 81% of providers this year told us that their non-staff related expenses had increased significantly more than 5%. That's a 26% increase from last year. So that non-staff related expenses, that's things like utilities, so energy bills, food bills, insurances, maintenance, all of those kind of things have really this year been felt as a significant increase to businesses. And 19% had reported increase slightly, which is that reduction. So you can see that that's been a shift this year. And what I would say is I haven't done the analysis for every sector yet, but residential, this one looks quite different to the overall. So I don't know yet whether this is very specific to the residential market. It may be, but I'll be interested to hear either now or, later after this presentation, does that feel right to you guys in what you're experiencing? We asked about top 3 cost pressures, and the top 3 this year, so very similar to last year, around workforce related costs being one of the top 3. Utilities was up there this year, as was maintenance. And that utilities and maintenance top 3 has replaced last year's, which was technology and insurance. Both of those items were still quite up there in terms of how many providers told us that they were one of the key pressures, but utilities and maintenance has now kind of topped that chart. And the way in which providers have been dealing with cost pressures. So similar to last year, the main number 1 has been internal efficiency savings. So year on year, that seems to be what providers are saying. We're just doing as our business as usual, trying to be more efficient, trying to create those efficiencies. But curbing investment now was the second most popular response here in a way to deal with cost pressures that replaces growing or increasing income. So you can see again that that's a shift that providers are saying instead of, well, not instead of, but one of the main ways of dealing with this has been we've actually had to curb investment rather than, continue to diversify or continuing to try and find ways to increase income. And number 3 is utilising reserves. In the most recent 12-month period, 47% of providers reported that they were operating in a surplus position, but that is 17% less than last year. 34% of providers told us that they are already operating in a deficit position, which is 7% more than last year. And 19% either wasn't able to provide an answer to this or chose not to, which is a 10% increase on last year. And the final point for this slide, 47% of providers have reported 47% of providers who reported a surplus financial position have told us that that position has decreased significantly in the last 12 months, and that's a 20% increase. So overall, what I'm taking from that analysis is that we have less organisations that have completed this survey who are operating in a surplus position, and those that are in a surplus position are reporting that that is decreasing significantly over the last period of time. I think I'm now going to hand over to Claire. Claire's, these slides that you see here, I mentioned there was lots of opportunity to provide qualitative information, so extra detail, and these have been summarised over the next few slides.
Thanks, Becky. Yeah, so we just want to delve a bit more deeper into the sort of feedback and what you're reporting to us. So just starting with those staff-related expenses, you're reporting that an 8 to 10% rise in sort of overall staffing costs, arising from those sort of unfunded increases to national insurance. The impact of this has been that for some of you, you've had to reduce your staff hours and bonuses to offset those increases, and you're finding it increasingly hard to absorb those extra costs that are coming from that. Now, obviously, wages are important to attract the right people into the care sector, and recruitment and retention is coming out as an issue with those stricter immigration rules and the sponsorship costs, making it more harder to attract and retain staff. And the onboarding and compliance comes through quite a lot as well through all of this from various things. That's making it more challenging. So the proportion of the comment there around proportion of migrant workers and staff must be paid the Home Office minimum. So that creates challenges. Again, that's another higher increase of costs, and the need to compete against other businesses like Tesco's that can pass on their costs where your rates are fixed. So that's coming through strongly. For the first time, well, what's coming through newer, this instance is training, particularly face-to-face training. You're reporting that's much more expensive and more costly, and you're sort of experiencing that they're rising. There's fewer options available. There's a lot of training on the international recruited staff to meet the UK care standards, and you're struggling to sort of keep those training standards within the budget. And as we know, these things that we're beginning to look at in detail are the things that start to impact on the quality of care that we were talking about earlier as well. You know, having good staff, well-trained staff, it impacts on that care quality. So we're interested to understand anything that you would have in terms of feedback around that. So we're just going to move on now and look at the non-staff related expenses. And as we said earlier, we've seen a bit of a shift here in sort of the sort of what you're reporting, whereas it was things around tech and insurance costs. Tech is here, but in a slightly different way. And utilities and maintenance are coming through much more strongly, that those things are becoming a bit more challenging, that investing in the service. So with utilities and energy supplies, whilst some are the pressures, the increases have eased, but they're still well above previous levels. And food inflation is coming through for the first time. So in those instances, those costs have doubled. And the waste insurance and that sort of thing. So you can see there the sort of comments that have come back through on that. And obviously this is particular to this sector as well, residential and nursing. You don't necessarily get that in the other sectors. With technology, the need to upgrade IT, fire safety improvements also came through as unavoidable expenses that you know stretch those budgets. Sometimes that means having to take on extra staff to deal with that. And there's lots of compliance changes that come with extra bills. You can see there about the local authority and CQC digital requirements add costs you can't recover. So yeah, there's still that need to sort of invest and keep pace with change, I suppose, which is you're finding it difficult for those budgets to stretch to cover all of that. The maintenance came in strongly this time, with cost of maintenance and repairs and equipment climbing. There's shortage of contractors, inflation materials. It can be expensive, really expensive to sort of invest in those services. And sometimes there are works that haven't been budgeted for, which need to be, they're unavoidable, you need to deal with them. So you can see the sort of comments there, and insurance and property costs also are coming out as sort of some of the pressures on the services. Yeah, so if we move on. So we asked this question as well last year about, has your organisation considered exiting the market in the past 12 months? I think last year it was 45%, this year 46%, so that hasn't really changed. The comments we've got coming back there are sort of, I suppose, iterated in what we've seen previously, that some of those reasons are the uplifts are given little margin to remain stable, so there's rising costs and fee increases. You're experiencing ongoing financial strain. That gap is widening between expenditure and income, meaning you have to sort of sometimes breach bank covenants or rely on higher paying placements to stay viable. Regulation and scrutiny, as I say, we've already touched on that, which can impact the quality of care or the dedication of care provided. And yet, well, you want to keep those without impacting on the quality and dedication of care provided. The survey, we've sort of got a sort of feedback from those smaller and more independent homes being under more of the greater pressure than the larger organisations. That's probably due to the lack of the bargaining power of larger groups isn't experienced by the smaller ones, and they can't spread those costs and manage the things across a wider portfolio, which makes it a little more challenging for smaller and independent operators. Again, there were some providers said that they are thinking of reviewing or closing services that are no longer commercially viable, especially where placements are funded below costs, and that was mentioned as well last year. So looking ahead, we asked what you saw being the pressures ahead and what things we could do differently for next year. So you sort of said that workforce related costs, maintenance costs, regulation, you expect those continue to be the biggest pressures next year, with staff related costs increasing, but particularly the non-staff related costs. 84% of you said that those were you expected those to increase. So I think that's what we've seen as a different shift this year in the survey feedback compared to last year. So how can we work differently to manage the pressures? So it's about fees. You thought that fees that match the real costs and reviewing those rates. As we've mentioned earlier, there's work underway. We've already got that underway as a local authority to begin looking at that, and this survey and that feedback goes into that process and is taken into account. And equally, everything you say today and all that feedback you give will be feeding into that process. You've suggested that we look over the longer term and agreeing uplifts and contracts before the financial year starts, and exploring multi-year fee agreements. Obviously, we've only just had as a local authority annual budgets from government, which has made that challenging in the past, but there might be an opportunity to look at something different going forward. Speeding up placements, settling payments and invoices promptly. So we are doing some work around that as well as a council, and changing our sourcing and how we source care and our operating model that we should see improvements next year as we move more functions into our brokerage service. The feedback said that focus on practical improvements and not new projects. You suggest the feedback coming back was that we need to fix the issues that we currently have. So improving the brokerage communication, reduce duplicated quality visits, and simplify contract monitoring instead of adding new initiatives. The coordination was suggested around reducing the overlap between CQC and PAMS and aligning that quality support. And then sharing solutions to reduce costs. So working together on joint procurement, training, which we saw was a big pressure in coming through, and exploring those collaborative approaches to workforce development and sponsorship, which is an area the local authority gives a lot of support already around workforce and sponsorship and international recruitment. So there's some things that we can look at working together on there. I'm going to hand back to Becky now, if that's okay.
Thanks, Claire. So there's quite a lot of information in there, and believe it or not, that was the shortened version. There was more. So what we'd like to do now is just pause us, stop talking for a little bit, and we're happy to stick around, and we've got a question to ask you. But if you've got some questions that you'd like to ask us, then now is the time that we can do that. And then once we've been through this next little portion of time, we'll say thank you very much and depart. And I believe that NorCA will continue the conversation with you guys separately. So from us, how did those findings feel to you? Were you listening to some of that and thinking that does feel like that's reflecting your experiences of the financial operating environment at the moment? Were there things that you'd like to add, or examples, or any sort of experiences that just add value to that information? Or conversely, did it not feel like it represented? So any comments at all would be most welcome. We'd like to hear from you guys.
This is everybody's opportunity to give feedback, even if you are confirming or denying what Becca and her team have said.
I think most of everything that you've put down resonates with probably everybody on this call, and probably most providers. I mean, looking at things like energy costs, there's a lot of people that have come off their fixed term contracts after the energy rises. I mean, we were certainly on a 5-year contract. We put ourselves on a 5-year contract just before the war started and the prices rose, because we anticipated them going up. That period has ended and we are facing significant energy cost increases. Maintenance wise, again, it's one of those things. That's one of the things that people can say, well, do you know what, we won't paint that wall this year, we'll do it next year. You know, you get a PAMS inspection, they say, oh, your skirting boards are scuffed. Well, yeah, because we've had to put that off. We know they're scuffed, but these are the little things that get put off when people are struggling with budgets and things. And one of the other things that, you know, a lot of feedback that I'm getting from different providers is about the keeping up with the regulations of the fire services. You know, I've heard of people, some coming in and they say, prove that's a fire door. Well, it's been there for 20 years or whatever. It's got the strips on. It's you knock it, it sounds like but you can't prove it because it's been there for that long. So then they want it replaced, and you get the fire door replaced, and they said, was the person who replaced it qualified to fit a fire door? And where's his qualifications, and what are his qualifications? You think, well, he's a carpenter by trade. He knows how to fit a door. What qualifications are a carpenter meant to have? I mean, do they hold an ology in carpentry, or is it a trade that they've picked up? So then you get an issue where they say, right, we want a certified installer, and then somebody comes along and says they'll charge you £1,000 a door, and you've got 20 doors in a building and you're a small home. These are the sort of things that are making it almost impossible for providers to fund. And there's so many things that, you know, just even trying to get a plumber these days, or an electrician, or somebody to come out if a fuse blows or something, it's so expensive and it's so difficult, and it always happens on a bloody Friday night as well, you know, when you can never get anybody out. So I really see the challenges in terms of maintenance and energy costs and everything else that people are facing, and it's really hard. And I think one thing that we just don't allow for in these surveys is you've got 46% of providers and owners that have completed this. Does anybody ask them about their mental health and stress that they face when it comes to juggling all these things and having to deal with all these things? There's a huge cost to that, and this is why you've got a lot of small providers who think, do you know what, I've had enough. I'm coming up to retirement. I don't need this hassle, and that's why you've also got a high figure of people thinking about exiting the market, because they simply don't need that sort of, you know, bureaucratic ton of weight falling on their head because they've got to do this, this, and this. And I think in terms of sustainability, sorry, I'm going on a bit. If you've got providers that could exit the market, they probably would do. But the issue is that anybody coming into the market has got to make that investment pay by way of, you know, finance or whatever. And if the margins aren't there, because you know, again, we're seeing people's surpluses decreasing, there's no bank in the world that's going to lend money to those people. And therefore, you're going to see a loss and a shrinkage in the sector, and it will happen very quickly because there's a lot of, you know, whether you keep data on aging providers or retiring providers, it's not just the staff and the managers, but also the people that sort of support the services. So I think that's something that you perhaps need to look at in future surveys, and try and get more information from providers as opposed to managers, and maybe split your surveys accordingly.
It
Sorry,
definitely goes
I
full circle,
rambled on
doesn't
then.
it, Raj? No, no, not at all. It definitely goes full circle, doesn't it, with where you were mentioning earlier about questioning behind quality in Norfolk, and how far behind Norfolk may or may not be. But it kind of goes full circle, doesn't it? Because you know, with things like the emerging data about rising costs that we all know about from our own households, never mind at a provider level, even down to training, you know, looking at that tripling, £1,000 a day plus VAT, you know, for all the additional training needs that providers now face, that, you know, 2 years ago we didn't have some of the things that we have now even, and that money's got to come from somewhere, hasn't it? So I mean, are there other people who are with us this morning that would like to underpin what Raj has said, or challenge any elements, or add some specific examples to that would be helpful for the NCC team?
Maybe I could just add one other thing to that. We were talking about quality, and to me, quality is key in the services that we run. And you mentioned earlier about NorCA providing the peer-to-peer sort of services, and I think there's far more providers that could avail from a sort of unbiased peer-to-peer type support service, because although people may not speak out in public forums and things, I can't imagine that there's one single manager or provider here that doesn't have, you know, the desire to sort of talk to somebody and say, look, can you come and look at my service? I've got this problem, you know, being non-judgmental about it. And I think those are the sort of things that are going to help us. You know, if we have a non-judgmental sort of peer-to-peer type operation where people feel that they are in a safe space, that they can ask a question that may deem them to appear, you know, wrong or whatever. And I think that's key. And I also know that the quality assurance team have been piloting a sort of mentorship program, which we've actually taken advantage of because we had a new manager that took advantage of it. And it's been absolutely fantastic. And I just wish that there could be more of this non-judgmental advice available from Norfolk County Council and from the various departments like fire and QA and you know, and people should feel that they should go. There used to be a time years ago, you know, where I could phone up our QA officer and say, Roger, I've got a problem. I don't know how to handle it. What do you reckon? And he'd say, well, I'll come down and see you tomorrow then. And he'd pop down and he'd go, oh, yeah, this is a problem. Have you tried this? Have you done this? Have you done that? I said, well, yeah, we did this. And, you know, and we'd come up with a solution together. But I just felt at that time it was all very non-judgmental. You know, if we had any sort of issues, we could talk to somebody. Now it's very much a case of people feel that there's an inspectorate body and we can't tell them too much because, you know, they might look under the rug or whatever, you know, and there isn't that openness. And I'd like to see more providers engage, and I'd like to see Norfolk County Council engage through NorCA and have those more safe spaces. And that will help us improve quality immensely. You know, sharing information, sharing advice. If we've got a document that needs to be completed by the PAMS officer, why is that document not being shared amongst every single provider? Why is it that they have to come in and inspect and tell you that that's not good enough or you haven't done that right? Surely that, you know, this comes back to the training issue as well. You know, things are changing and evolving so fast. We need to keep on top of the education. We need to keep on top of the training. But managers don't always have that time. And the cost, as you said, £1,000 a day. I've seen it more than that. You know, I've had moving and handling trainers quote £3,000 for like, you know, having 15 people, and you think, what? It's crazy. So let's not do it. Let's try and do it in house. Let's try and just, you know, and if we were to provide that whole element of safe space training and education, and being able to ask the stupid questions that we think might get us into trouble, I think we'd do so much better.
I think it's it's about collaboration and knowledge sharing without judgment, isn't it? And without fear of recriminating actions because you've dared stick your head over the parapet, really. And that's quite sad, isn't it, really? Because, you know, as providers, we all want to do the best we can. We all strive for the highest quality possible. But there is that element of fear, which I'm hearing, Raj, around, you know, I hardly dare ask the question because I might be opening a whole can of worms here for myself that I can't actually meet what might follow.